Welcome and get ready to dive into the thrilling world of investments, where numbers dance, money talks, and the unexpected always keeps us on our toes. Do you want to know the secret of earning a solid 35% return on your investment? Well, if you have the legendary Warren Buffett on your side, it's not just a far-fetched dream anymore. Get ready to unlock the key to financial success with Warren Buffett's top strategy. In this video, we're diving into Buffett's tried-and-true methods that have consistently produced extraordinary outcomes. Without further ado, let's tap into the wisdom of one of the greatest investors of our time and unlock the secrets to achieving remarkable success. Rule number 1: forget stock gains, focus on business success. Here's a golden rule for investing that you gotta remember: buy success businesses, not stock gains. Now, this rule didn't come straight from Warren Buffett himself, but rather from the person who mentored Buffett, legendary investor Benjamin Graham. You might know him as the author of the classic book, The Intelligent Investor. Graham taught Buffett something crucial: when you buy a stock, you're essentially buying a piece of that company's business. So forget about obsessing over short-term market trends and instead focus on finding companies with a bright future. Look for businesses with strong profit margins, a killer competitive advantage, and loyal customers. Trust me, when the business thrives, your investment is more likely to succeed. Let's consider NVIDIA as an illustrative example. In 2022, its stock plummeted by a staggering 70% from its peak. However, the company itself remained robust. Soon enough, the stock price rebounded and even surpassed its previous high. The same story goes for Apple too. Despite enduring a roughly 30% nosedive in its stock last year, its business remained solid. As the market rebounded in the first half of 2023, Apple's stock price recovered and reached new highs to reach $3 trillion market cap. The lesson is clear: have faith in the businesses you invest in and disregard temporary fluctuations in stock prices. Warren Buffett urges us to delve even deeper into our investments, emphasizing the importance of comprehending the industries and companies we allocate our capital to. This entails extensive research, meticulously examining financials, dissecting competitive advantages, and evaluating the competence of management teams. By adhering to this principle of investing in businesses for long-term success rather than pursuing immediate stock gains, we position ourselves for substantial victories. So, venture forth, place your belief in the businesses you acquire, and let us make prudent moves in the realm of investing. Rule number 2: don't believe the hype. Let's talk about Buffett's second rule, something that often gets overlooked but is absolutely crucial for investment success. He has a bold perspective: much of the news surrounding investments is, in fact, deceptive. We find ourselves inundated with a deluge of financial news from various sources on a daily basis. Television shows, newspapers, and even popular YouTubers vie for our attention, seeking clicks, views, and ratings. They generate hype around market events. But here's where Warren Buffett stands apart. He firmly believes that the majority of this news does not contribute to making wise long-term investment decisions. He sees through the constant chatter regarding markets, the economy, interest rates, and other potential distractions that easily sway investors. Buffett recognizes the trap that many people fall into, allowing the unpredictable behavior of others to influence their own choices. They become swayed by the noise, opinions, and predictions prevalent in the media. Buffett advises against assigning excessive importance to these so-called experts and commentators. He urges us to maintain a long-term perspective and concentrate on the truly significant aspects of investing. By filtering out the noise and distractions, we can make more logical and well-informed decisions. Let me be clear though, staying informed is important. But not all news is created equal. It's crucial to separate substance from hype in order to navigate the investing world successfully. So remember, don't believe everything you hear or read. Stay focused on what truly matters in your investments. Rule number 3: stay in for the long haul. Now, let's explore Buffett's third rule of investing, a familiar one that resonates: hold forever. This rule revolves around harnessing the power of compound interest and recognizing the value of time in the market, akin to leveraging dollar-cost averaging. Imagine if you had started purchasing NVIDIA stock when it had plummeted by over 50%. Guess what? If you had held on to it until now, your investment would have more than doubled. While everyone else panicked, succumbing to the influence of self-proclaimed market experts spreading negativity, the business thrived. You may have come across the concepts of compound interest and dollar cost averaging before. They are like secret weapons in the realm of investing. Reinvesting dividends or capital gains can significantly enhance your returns over time. However, here's the crucial point: if you frequently buy and sell stocks, you miss out on the potential power of compound interest. Attempting to time the market becomes a risky game. That's why Buffett advises us to prioritize allowing our investments sufficient time to grow. Buffett suggests being prepared to hold on to a stock indefinitely. When you have carefully assessed a company's strong fundamentals, solid growth prospects, and competitive advantage, there is usually no urgent need to sell. Simply let your investment ride over time. This patient approach empowers compound interest to work its magic, presenting opportunities for substantial long-term gains. We can learn from Buffett that successful investing entails more than chasing trends or striving to impeccably time our buying and selling decisions. It revolves around making intelligent choices, constructing a diversified portfolio, and having confidence in the long-term growth potential of our investments. Rule number 4. Stay grounded, avoid greed. Now, let's delve into a rule that holds immense wisdom, especially when the market is on a wild ride. As Buffett himself famously said, "Be fearful when others are greedy." This rule is particularly valuable during extended periods of bullish markets. When stocks like Apple reach a staggering $3 billion market cap, it's natural for investors to be swept up in the frenzy and succumb to greed. It becomes easy to feel invincible and excessively confident in our investing abilities. Consequently, a surge of capital floods into the market, making it more challenging to uncover promising investment opportunities. However, it is precisely during these exuberant times that exercising caution becomes crucial. Warren Buffett himself exemplified this principle this year by maintaining more than $100 billion in cash, according to Berkshire Hathaway's 13F filings. He understood the importance of exercising restraint and patiently awaiting the opportune moment. When panic strikes and fear takes over the stock market, Warren Buffett will be ready to seize the opportunity. He has an uncanny ability to spot value when others are gripped by fear, eagerly scooping up stocks at discounted prices. Therefore, in a world driven by greed and market euphoria, it is imperative for us to remain grounded. While everyone else becomes entranced by the frenzy, let us retain a level-headed and strategic approach. Stay vigilant for exceptional investment prospects that may arise when others are blinded by greed. Remember this: do not allow greed to cloud your judgment. Exercise caution when others abandon it recklessly. By doing so, you position yourself for success even when others are blinded by their own desires. Rule number 5. Understanding company performance. Now let's explore Buffett's final rule: the importance of company performance. Buffett recognizes that evaluating a company's return on equity is crucial in gauging how effectively shareholders are earning income from their investments. ROE provides valuable insights into a company's profitability and efficiency, revealing the returns shareholders generate on their shares. Buffett examines ROE to determine if a company consistently outperforms its industry peers. Calculating ROE is relatively straightforward: divide the company's net income by its shareholders' equity. However, here's the key: examine ROE over an extended period, such as 5 to 10 years, to obtain a comprehensive understanding of the company's performance. By analyzing ROE over time, we can spot trends and patterns in a company's financial performance. This helps Buffett assess whether the company can sustain its returns and beat its competitors in the long run. As investors, we can learn from Buffett and prioritize understanding a company's ROE. By looking at historical performance and seeing how a company's profitability has changed over time, we can make smarter investment decisions. And that wraps up our journey through Warren Buffett's investment rules. We've explored strategies for achieving great returns. Remember, his approach is all about taking the long view, doing careful analysis, and protecting our capital. Successful investing takes time, effort, and ongoing learning. Thanks for joining us, and we'll see you in the next one.